All right, guys, welcome back for another video. Well, I previously uploaded a video talking about the largest whale in the Bitcoin space and documented the effects it has on price action. And I just want to do an update to that video. There's another good example of this Bitcoin whale directly manipulating price. And you can see that by tracking the public wallet. Anybody can go to this bitinfocharts.com and track this wallet address. This wallet has a long history. Sometimes coins move between wallets. So while this one doesn't have a long history, if you track the string of addresses in the wallet, you can tell that this wallet actually does have a very long history of accumulation. But in this video, what I want to talk about is where it's distributing or its distribution and the effects that has on the market. So in this chart, I've marked off each uh, market top where this whale has dumped coins. And this is going to tie into a liquidity concept. Um, you know, but I'll talk about that a little bit more. But first, I just want to dive into, exactly where this whale has distributed. So you've got the first one I want to talk about here is this 500 BTC output, 500 BTC output at 728 and 726, roughly combined on July 28th for 1,000 BTC. Coins probably flowing into exchanges, hitting the market as sell orders. And what do we have right here? Well, this is the 28th. Does the whale get the perfect top right here? No, not exactly. But, basically gets the entire top. Now, what I want to point out here and notice is and tie this into liquidity concepts is as I go on, you'll notice that this whale is always distributing above previous highs, right? So this liquidity gets ran above this high, and then the whale distributes, sends 1,000 coins to the exchange and dumps it on the exchange. And that's very important, right? This is a very important concept because liquidity is greater for these larger players in these areas above old highs, right? So it runs up above, tags stop loss orders up here. There's just more liquidity if you want to sell up here than there would be at the lows. And you'll notice this whale tends to sell above the highs where there is more liquidity than above the lows. So if we go on, you've got this other one here on September 12th, 1,000 BTC output, probably in the form of sell orders hitting the market. And what do you know? September 12th, right there, Monday, September 12th, you get a dramatic market top, right? This whale dumps 1,000 BTC on the exchange. Boom, there you go. Let's move on. So now we've got another one, October 5th, 1,000 BTC. The whale distributes. Let's find October 5th on the chart, right there, another top. Now notice that these are all running above highs, right? So the whale, this runs just above this high. It may not look like an obvious high on the daily chart, but if we go down to a 4-hour chart, it's running above this previous high right here, run just above, and then the whale dumps 1,000 Bitcoin. Let's go back to the daily chart. This one here, this top where the whale dumped 1,000 Bitcoin, not, a swing high really, but running above these highs right here. It's always running above liquidity to generate liquidity to fill their sell orders. And now the reason for this video is the update right here. So we actually have a new transaction here from this whale on October 26th. And October 26th, right there, running above these highs right here. Again, another 1,000 BTC sell order above these old highs where liquidity rests. And, obviously that is having a pretty, you're seeing that reflected in price, right? Price is running above liquidity. The whale hits the sell orders and price sells off. Now, is this going to be, an ultimate top? You don't know for sure, but the point is to illustrate the concept that this is a very repeating characteristic, right? And it ties into liquidity concepts, right? If you want to sell or you want to fill your liquidity in your for your sell orders and you're a big player, you have to run above old highs. And conversely, if you want to fill a buy order, a lot of times you have to run below old lows, right? And where a lot of people have their stop losses set. And this is very, very basic liquidity concepts. Um, it's just one of those things where you kind of have to interact with the market long enough to realize that, and especially in a market like Bitcoin, right, where Bitcoin has a very fixed supply. So there isn't a lot of liquidity in the form of circulating supply on the market at any time, right? So you guys are probably familiar with BlackRock, the largest asset manager in the world. Well, they actually entered the Bitcoin spot service area. So, and by that I mean they're offering spot Bitcoin to their clients. They actually announced that back in August. So, for somebody like BlackRock to fill a Bitcoin book, there's just not enough circulating supply on the market. So, they need to engineer liquidity, right? Well, how do you engineer liquidity to the downside? Well, you run below old lows, right? So, I mean, we may have gone through a period of accumulation. I mean, we've been at these lows for 5 months, but so I'm not going to speculate on whether they're done accumulating or any of that. But I just want to illustrate the concept that you know if somebody of that size wants to fill orders or fill their liquidity, they have to run old lows. They have to take out those stops. And again, it's a very simple concept, but I think people fail to grasp it because it's directly contradictory to market psychology. People, and it also goes directly against trending behavior, right? If the market runs above old highs to run liquidity, then people are going to say it's higher highs, right? We've got higher highs. This is an uptrend. And conversely, if the market runs below old lows, people are going to say, "Oh, this is a downtrend," and there may be an element of truth to that, but they're missing kind of the liquidity game that's playing out behind the scenes, right? So while they may see half of the picture, they're not seeing the full picture unless they uh, understand these concepts. Now, I really think the fact that this wallet is available for view is really fascinating. I mean, you know, in this video, I talked about the distribution of this wallet. But if you're looking at it, you can tell obviously that this wallet isn't really characterized by distribution. It's you know few and far between distributions among major inflows of Bitcoin, and you know it, it's a wallet that nobody knows who owns this wallet. Um, After this recent distribution, if it keeps distributing, it'll be less Bitcoin than Michael Saylor and MacroStrategy have, or excuse me, MicroStrategy have. Um, but for a while, this was the largest wallet. And what makes that especially unique is that nobody knows who this is. Um, you know, People can speculate who it is, but you know, it's not a public facing address. It may be an entity, it may be a state owned organization. Who knows? The one person who would know is Coinbase because one of the previous address history for this wallet actually flowed through Coinbase. And Coinbase obviously is a KYC exchange. So any coins flowing through Coinbase is going to be KYC'd, meaning know your customer. They're going to identify the identity of whoever's using that gateway. So whoever this is, Coinbase knows who they are, but we don't. All we can do is speculate. Now, I think one thing that is really interesting about the accumulation and distribution dynamics of this wallet is that there's really no ordered structure to the way that the accumulation occurs. Right? It almost seems like whatever entity this is just sweeping cash flow into Bitcoin, just sweeping excess cash flow. But the distributions are way less random than the distributions, or excuse me, the sell orders or distributions in the wallet are far less random than the accumulations. And by that, you can see this by the, you've got very surgical 500 block BTC right here, 500 block BTC, 500 block BTC, 1,000 block BTC, 1,000 block BTC, 1,000 block BTC. And remember, if we go back to the price chart, those mark these market highs. You have the two 500 block order here for 1,000 BTC right here. You've got the other 1,000 block order right here, another 1,000 block order right here, and another 1,000 block order right here, leading to an intermediate top. So that type of structured distribution tells me that this is an entity that is using structured distribution for, probably accounting purposes or investor reporting. Every institution does quarterly P&L statements. So, maybe, these distributions aren't necessarily around the quarterly close, but they are sort of structured in the time between them, right? So they're roughly a month apart, more or less. So if, this is total speculation, but, it may be an entity that is, trying to generate monthly cash flow models. And if, maybe distributing Bitcoin, if needed on a monthly basis to meet its monthly cash flow needs, right? And, this would probably, judging by the accumulation of Bitcoin in the wallet, would probably be an entity that's profitable, right? They don't need to draw on their savings or their Bitcoin very often to meet their cash flow needs. The type of entity that would do something like this or use Bitcoin in this fashion to meet cash flow needs is, and a lot of probability, probably an energy producer. Um, energy prices have been extremely erratic recently. You've got electricity in France and Germany going 20x, and then natural gas, in the last few weeks going to zero, essentially. So you have like this incredibly historic volatility in the energy markets. And if you are an energy producer, a major, like a major energy conglomerate like Exxon or Shell Mobil, most of those companies have mining wings of the company. And, they can effectively use the mining wing of the energy company as a way to monetize energy when the energy is cheap, right? And this is especially valuable when you have like, you know, incredibly volatile energy prices, right? You can, because so for example, when natural gas went to basically zero in the last few weeks, right? The amount of natural gas you can accumulate at those prices is limited by the amount of storage space you have, right? There's a certain amount of storage facilities you have to warehouse that natural gas, but in a certain amount of time that you can store it for, right? Before it, there's just natural limitations to physical commodities like that. So there's only so much you can store in warehouse at, those lower prices. Well, what do you do with your excess? How do you monetize those low energy prices, when you have limited storage facility? How do you take advantage of that? Well, you can monetize it by using that energy to mine Bitcoin, right? That way you don't have to store it. You're not, you're using the energy at the low prices, but you're effectively monetizing it by using it to secure the Bitcoin network. So it's a good example of how, major energy producers can capture the volatility of the energy market and arbitrage it by using Bitcoin mining. In effect, and then on the flip side, right, they can monetize energy when it's cheap, and then they have a store of Bitcoin, right, so that when energy ultimately is expensive, that they can use that monetized energy as a way to, and sell that to secure real energy, right, to bridge the financing cost when energy prices are high and when the volatility goes to the upside. And, they still obviously energy demand is inelastic, you need some way to secure energy, even if it's at higher prices. So anyway, it's obviously this is total speculation, but that's my best theory for who this entity is. Anyway, I hope you guys like this video. If you do and you haven't subscribed to the channel, please make sure to subscribe, and I'll catch you guys in the next upload.